Key investment themes for 2023. Let's go. This is Kyle with Fundamentals of Finance, and today I'll be talking about why bonds are basically more attractive now than they've been in my entire career, and probably in your lifetime as well. In this video, I'll cover the two main reasons I think bonds are so attractive right now, and then I'll finish off by getting into more specifics about which area of the bond market is most attractive, because some parts look much better than others, and how you can invest there. Let's start with reason number one that bonds are so attractive, the starting place. 2022 was by far the worst bond market of all time. Before, the worst year had been 1994, when bonds fell 2.92%. But in 2022, they fell over 13%. In short, a combination of two factors caused this. Number one, yields started extremely low, so there wasn't much of a return buffer. And two, rapidly rising inflation led the Fed to raise interest rates significantly. But where do we sit now? AKA our starting place for 2023. Well, yields on short-term, high-quality bonds have risen to around 5%. This is really important because the yield is almost always your main source of return as a bond investor. And that's also what cushions you from the losses due to rising rates. It's not that we've never had rapidly rising rates before, it's just that we've never had them at the same time as really low yields. Well, unless we have a time machine, we can't go back in time and avoid 2022. But from here, bonds that were offering a return of less than 1% a year ago are now offering more like a 5% yield. Not only does that mean greater return potential, but it also means much less risk of losing money from here, even if rates keep rising. So the first reason bonds are so attractive right now is the starting position is better than it's been at any point since 2008. The second reason is the outlook. The main reason bonds struggled so much in 2022 is because rates rose so much. Well, is that gonna happen again? Highly unlikely. Yes, the Fed is going to keep raising rates, but there's pretty much close to a 0% chance they raise them anything close to how much they did in 2022. Why, you might ask? Well, in 2022, we had just come off a massive stimulus plan in 2021. We still had a lot of supply chain bottlenecks, housing prices went up a lot, and we had rapidly rising food and energy costs due to the war in Ukraine. All of this led to rising inflation, and the whole point of Fed rate increases is to lower inflation. In 2023, we'll be 1 year further removed from the stimulus, so that will have less of an inflationary impact. Most of the supply chain bottlenecks have been resolved, and as China opens up, that could continue to improve in 2023. Housing prices and rents have started to cool down and could even be deflationary in 2023. And food and energy prices rose largely due to the shock of the war in Ukraine. So unless we have another major shock like that, it's really unlikely that they will rise like that again from here. In fact, like housing prices and rents, food and energy prices have also been falling lately. So will the inflation get all the way down to the Fed's 2% goal in 2023? I doubt it. But will it be over 7% 1 year from now? I also very highly doubt that. With inflation cooling off, the Fed should be able to at least slow down their pace of rate hikes and likely pause them altogether, which would mean a much better environment for bonds in 2023. Let's recap the two components. Going into 2022, there was very little return potential in bonds from the ultra low yields and very high risk from all the inflationary pressure. Going into 2023, there is much greater return potential from the higher yields and much lower risk given that inflation is now falling and will likely continue to do so. But hear me out. Not all bonds are really attractive right now. So that brings us to our final section. Which bonds offer the greatest risk-reward potential and how can you invest in them? For me, it's high-quality short-term bonds. Yes, you can get a higher return from emerging market bonds or high-yield bond funds if things go well. But heading into a likely global recession, there's also a lot of downside risk in those. Yes, you can get more upside potential if rates fall by buying longer term bonds, but you also have greater risk of losses if inflation stays stickier and the market prices in a greater likelihood that interest rates stay elevated for longer. That's precisely what I think will happen, by the way. So given the risk of a recession, I think it makes most sense to stick with high quality bonds. And given that the yield curve is the most inverted it's ever been, I think it makes sense to stay with shorter term bonds. So you might ask yourself, Kyle, what does an inverted yield curve mean? Well, the yield curve shows you what treasury bonds are paying you at each maturity. Normally, this goes up from left to right, like you see here with the blue line. That would mean that you get paid more to buy longer term bonds, which makes sense because they're risky. In an inverted yield curve, the short maturity bonds pay you more than the long maturity ones. And when you look at the yield curve right now, you're getting paid way more to invest for 6 months to a year than you are to invest for 5 years or longer. Put simply, I just don't think you're getting paid enough to take the risk of investing in longer term bonds. You can literally get a higher yield with lower risk when you invest in short-term bonds. That's why I think a high quality short-term bond fund makes most sense in this environment. High quality because we're probably heading into a recession, and short-term because you get a better bang for your buck in short-term than long-term bonds right now. One fund to consider for this kind of exposure is PIMCO Low Duration, which has a ticker of PTLDX. Not only is it managed by one of the top fixed income investment management companies in the industry, but with a rating of silver, it's also one of the highest rated short-term bond funds by Morningstar. At a 0.46% expense ratio, you can see it's fairly inexpensive for a high quality, actively managed bond fund, and this chart here shows that it typically invests mostly in the kinds of short-term, high-quality bonds we're looking for here. According to their website, the effective duration of the fund was 1.68 years as of November 30th. So for some simple math, that means that if the underlying investments are yielding around 5%, interest rates would have to go up nearly 3% more in 2023 for you to lose money from the rising rates. Given how unlikely that is, I think short-term, high-quality bond funds like PIMCO Low Duration are more attractive than they've been at any time since 2008. If you've got cash on the sidelines that you don't need for the next year, it might be time to think about putting some of it to work. By the way, I started this channel to help Americans learn how the professionals invest. If you want to take your investing knowledge to the next level, check out the link below called the 9 Habits You Need to Be a Successful Investor. The link is in the description. Thank you for watching, and I will see you in the next video.